You've heard the statistic. 96% of traders lose money and quit. It's plastered across trading forums, whispered in chat rooms, and used by gurus to sell you their miracle solution. But what if the entire reason you've been given for why they lose is a complete and utter lie? What if the story you've been told is the very thing holding you back? I've spent years analyzing the performance data of thousands of retail traders and coaching hundreds of them out of the red. And I can tell you the one thing that separates the profitable few isn't a secret indicator, it isn't a revolutionary AI, and it certainly isn't a holy grail strategy. It's that they refuse to believe the trading lie that is keeping everyone else broke. In this video, I'm going to expose that lie. We're going to dismantle it. I'll show you the real psychological traps, the misunderstood technical mistakes, and the statistical realities that are quietly draining your trading account every day. If you are serious about not just surviving but thriving in these markets, then you cannot afford to miss this. The lie and the pivot to the truth. So, what is this great lie? The lie is that your failure is a strategy problem. The lie is that if you just found the right combination of moving averages, the perfect RSI setting, or the one pattern that never fails, you would finally be profitable. It's a seductive idea because it suggests the solution is external. It's something you can buy, find, or download. It removes all responsibility and puts you on an endless treasure hunt for something that doesn't exist. This treasure hunt is a multi-million-dollar industry. It sells courses, indicators, and Discord signals, all promising to give you that one missing piece of the puzzle. But it's a hamster wheel. It keeps you busy, it keeps you spending money, but it never actually moves you forward. You jump from one strategy to another, a behavior known as strategy hopping, never giving anything enough time to work. The moment you hit a string of losses, you assume the strategy is flawed, and the hunt for the next holy grail begins all over again. But the data is clear. The real reason most traders fail has almost nothing to do with their strategy. In fact, you could give a losing trader a profitable strategy, and they would still find a way to lose money. Because trading success isn't found on your charts. It's found between your ears. The real reason you're losing money comes down to 3 hidden traps that are far more dangerous than just having a bad strategy. These are the traps that the profitable minority has learned to identify and avoid. Section 1. The psychological lie: your brain is working against you. The first and most brutal truth is this: your brain is not naturally wired for successful trading. The very cognitive mechanisms that help you survive in the real world become your worst enemy in the financial markets. The profitable trader isn't someone who has eliminated emotion. They are someone who understands their own psychological biases and has built a rigid, unbreakable system to protect themselves from their own worst instincts. Here are the primary mental traps you're falling into. Trap 1A. The illusion of control and overconfidence bias. The illusion of control is a cognitive bias where you overestimate your ability to influence events that are, in reality, largely random. In trading, this is poison. You get a few winning trades in a row. Maybe you saw a head and shoulders pattern, shorted the market, and it tanked exactly as you predicted. Your brain releases a surge of dopamine. You feel like a genius. You start to believe you've figured it out. You think you have control. Overconfidence makes you feel invincible. So what do you do next? You increase your position size way beyond what your risk management plan allows. You see another setup, but this one isn't as clean. Your strategy rules say to pass. But your newfound confidence tells you that you can feel where the market is going. You take the trade anyway, bending your rules just this once. And then the market does the unexpected. The trade moves against you. But instead of accepting the loss, your illusion of control tells you it's just a temporary dip. You believe you can still will this trade into being profitable. Maybe you even add to your losing position a catastrophic mistake known as escalation of commitment. Suddenly, a small, manageable loss has snowballed into a margin call. In a single trade, you've wiped out weeks, or even months, of hard-earned gains. You didn't lose because your strategy was wrong. You lost because you allowed a handful of wins to convince you that you were smarter than the market. You forgot that your job is to manage risk, not to predict the future. The solution is radical humility. It's understanding that you only control two things, your entry and your exit. That's it. You don't control the outcome. Profitable traders internalize this. They aren't prognosticators, they are risk managers. They have a written trading plan with a checklist that must be satisfied before any trade is placed. This plan removes emotion and ego from the equation, ensuring every decision is strategic, not impulsive. It's not about feeling right, it's about being systematically correct. Trap 1B, the crippling power of loss aversion. Behavioral economists have shown that the psychological pain of losing is roughly twice as powerful as the pleasure of an equivalent gain. This is called loss aversion, and it is the single biggest reason why most traders obey the doomed mantra: cut your winners short and let your losers run. Picture this: you enter a trade, and it quickly moves in your favor. You're up a decent amount. Instead of letting the trade run to your predetermined profit target, fear kicks in. It's not greed, it's the fear that the profit will vanish. The thought of this winning trade turning into a loser is so painful that you close the trade early, locking in a small gain. You chose the certainty of a small win over the possibility of a larger one, just to avoid the potential pain of loss. Now let's flip that. You enter a trade, and it immediately goes against you. Your stop loss is approaching. Your trading plan, which you wrote when you were objective and rational, clearly states that if the price hits this level, your idea is invalid and you must exit to protect your capital. But what happens? Loss aversion kicks into high gear. Closing the trade means admitting you were wrong and, more importantly, realizing the loss. The pain feels unbearable. So you start to bargain. I'll just move my stop loss a little further down, you tell yourself. It will probably reverse here. You are actively avoiding the facts, a behavior known as the ostrich effect. Price continues to fall. Now you're down significantly more. The pain is even greater, making it even harder to close the position. You're anchored to your entry price, desperately hoping the market will return to break even just so you can escape without the sting of a loss. This is how a small, paper-cut loss, which should be a normal part of business, turns into a mortal wound that blows up your account. Research has shown that traders sell winning positions at a 50% higher rate than losing positions. This is loss aversion in action, and it is mathematically guaranteed to destroy your account over time. The solution is to reframe your entire perception of losses. A loss isn't a punishment. It's not a reflection of your intelligence. A loss is a business expense. It is the cost of gathering information in an uncertain environment. Professionals don't just accept losses, they plan for them. They define their maximum acceptable loss before they ever enter a trade. This is the entire point of a stop loss. By honoring your stop loss without hesitation, you short-circuit the destructive power of loss aversion and preserve your capital to trade another day. Section 2. The technical lie, the obsession with the wrong things. The second great lie is technical. It's the belief that success lies in perfecting one tiny part of the trading process while completely ignoring the parts that actually determine profitability. Amateur traders are obsessed with finding the perfect entry, while professionals are obsessed with managing their risk. This fundamental difference in focus is a primary driver of why so many fail. Trap 2A, the cult of the perfect entry. Go to any trading forum or YouTube channel for beginners. What's the main topic? What's the best entry signal? Is this a good time to buy? New traders believe, with almost religious fervor, that if they can just perfect their entry timing, they'll become profitable. They spend thousands of hours and dollars searching for an indicator or a pattern that will tell them the exact moment to click the buy or sell button. This is a fool's errand. The entry is arguably the least important part of a successful trade. Think about it. You could have the best entry signal in the world, one that's right 80% of the time. But if on the 20% of trades where you're wrong, you lose everything because you didn't manage your risk, your perfect entry is worthless. Conversely, you could have a mediocre entry strategy that's only right 40% of the time. But if you practice strict risk management where your winning trades are 3 or 4 times larger than your losing trades, you can be wildly profitable. Professionals know this. Their edge doesn't come from a magical ability to predict price. Their edge comes from the simple, unsexy, and brutally effective math of risk management. They understand that trading isn't a game of prediction, it's a game of probabilities. Their entire business is built around a concept called positive expectancy. The amateur is looking for a crystal ball. The professional is acting like a casino. A casino doesn't know if the next spin will be red or black. It doesn't care. It knows that over thousands of spins, its small mathematical edge will guarantee profitability. Your trading edge is your risk-to-reward ratio. When you structure trades where you stand to make at least twice what you are risking, one winning trade can pay for 2 or more losing trades. Chasing the perfect entry is a distraction. Focus on defining your risk and ensuring the potential reward justifies it. Trap 2B, the deadly misuse of leverage and position sizing. Leverage is the tool that lets retail traders with small accounts control large positions. It's marketed as a benefit, and it is. But for the undisciplined trader, it's also a weapon of mass destruction because it amplifies losses just as powerfully. Over-leveraging, combined with poor position sizing, is the fastest way to blow up a trading account. Most new traders determine their position size based on emotion. They see a trade they really like and decide to go big on it. This is a fatal error. Professional risk management is built on one cardinal rule of survival. Never risk more than 1 to 2% of your trading capital on any single trade. Let's do the math. If you risk 20% of your account on one trade and lose, you need a 25% gain just to get back to even. Lose 50%, and you need a 100% gain to recover. By risking only 1% per trade, you could suffer 20 consecutive losses and still have most of your capital intact. It gives you resilience. Proper position sizing is how you enforce this 1% rule. Your position size is a mathematical calculation. This ensures that no matter how wide or tight your stop is, the dollar amount you lose if you're wrong is always the same, 1% of your account. It standardizes risk. This is what it means to trade like a business. Most retail traders skip this entirely. They get funded by a prop firm with a $100,000 account and immediately start placing huge trades, not realizing that a small move against them will violate the firm's drawdown rules. They fail not because they couldn't find winning trades, but because 1 or 2 losses were so catastrophically large they could not recover. Section 3. The Statistical Lie, Misunderstanding the 96%. Finally, we come to the statistic itself. The 96% of traders lose money line. It's used as a scare tactic. But the statistic itself is a myth, or at the very least, a gross misrepresentation. The reality behind the numbers. More recent data from bodies like the European Securities and Markets Authority, ESMA, required brokers to display the percentage of retail clients losing money. These disclosures showed that while most traders did lose, the figures were typically in the 70% to 85% range, still high, but a long way from 96%. But here's the most important context that gets left out. Who is included in these statistics? These numbers include everyone. They include the person who opened an account, put in $100, made one YOLO trade, and never logged in again. These stats aren't a reflection of the success rate of serious, educated, and disciplined traders. They are a reflection of the failure rate of the uninformed public who treat the market like a slot machine. Of course, 96% of people who try to perform surgery after watching a few YouTube videos would fail. Trading is a professional endeavor. Why would we expect the results to be any different? The statistic isn't a statement about the impossibility of trading. It's a statement about the consequences of being unprepared. The statistic that actually matters. Worrying about the 96% is focusing on the wrong thing. The only statistic that should matter to you is what the profitable traders do differently. Studies of proprietary trading firms show that only about 4% of participants manage to make a living from trading. These are people with access to capital and mentors, and they still face a steep climb. But they prove it's possible. These consistently profitable traders have a system and execute it relentlessly. They keep a detailed trading journal because what isn't measured can't be improved. They review their performance, identify their mistakes, and work to eliminate bad habits. They treat trading as a science of math, discipline, and psychology, not a game of luck. So, forget the 96%. Your goal is to stop acting like the masses and start adopting the habits, discipline, and mindset of the professionals. We've covered the 3 great lies of trading. And I want to ask you a question, and be honest with yourself. Which of these 3 lies has been costing you the most money? The psychological traps, the technical missteps, or the belief in that discouraging statistic? Let me know in the comments below. Sharing it is the first step to conquering it. Remember, the market doesn't owe you anything. Success is not given. It is earned through discipline, resilience, and an unwavering commitment to managing your risk. Stop looking for the lie that promises to make you rich, and start focusing on the truths that will keep you in the game.